So our very first speaker is Samantha Emery from Glenhawk, and we have actually sent out the bridging guide because this came over yesterday afternoon, so we was able to add this to it. So you would have received this morning. This is their up-to-date one, launched literally yesterday afternoon. Hopefully hasn't changed since. I jest. A little bit about Samantha. She's BDM for Glenhawk, covering the Southeast, and brings with her over a decade of experience in the financial service industry, most recently at Together Money, where she was Regional Development Director for just under 3 years. Prior to Glenhawk, Samantha spent years at Barclays Bank, working across a number of roles, most notably as Premier Relationship Manager, where she was looking after nearly 700 high net worth clients. Samantha is a social butterfly and loves nothing more than meeting new people, as well as spending time with her existing connections across the professional sector. She gets real thrill from seeing clients achieve their dreams using property finance, whether that is buying a first or 100th investment property, a new or rundown commercial premise, or raising money to further their business. When not working, Samantha can be found enjoying a country pub lunch or a windy beach walk with her family, including a very hyperactive French bulldog. And there's Samantha. Can you hear us, Samantha?
Yep, can you hear me?
Yeah, absolutely perfectly. Right. Just one more bit, which is your interesting fact. Samantha has been on television twice, once as a baby in a Daz advert, and in November 2019, she starred in Bargain Hunt along with her mother, which in her words, it was great fun, but extremely cringe. Ha ha. Okay, I did actually do this with one of her colleagues, who weirdly enough, one of her colleagues, Pete, was in a Persil advert when he was younger, and I managed to find on Google an image of him in the Persil advert, which I put up on screen without his knowledge. I did search yesterday for the Daz and the Bargain Hunt, but nothing at all. So maybe she used an assumed name or something, just in case in the future someone decides to try and embarrass her with it. So Samantha, it's over to you. I'll see you in about 20 minutes.
Thank you. I am very happy that you could not find that image, because anybody that has, quite a few of my connections have somehow it seems to, especially the Bargain Hunt gets repeated quite a lot, and it is cringe.
I'll find it next time. Don't worry. I'll make it my mission. Right, over to you.
Thank you very much. Thanks for having me. So as Tony said, I'm Samantha Emery, Business Development Manager for Glenhawk. And what I do today is just want to go through a little bit with yourselves about bridging. And a little bit about Glenhawk and kind of where we've come from, but predominantly we'll focus on bridging as a whole, really, and debunking some of the myths of that. So Glenhawk were incorporated in 2018. Hopefully some of you have heard of us already, or if not, then you have certainly after this morning and Tony's introduction. So as you can see, by 2019, we'd lent 100 million. And actually, by 2020, we had 100 million in redemptions, which getting the money back in is just as important as lending it in the first place. It just shows that obviously you're lending to the right people and a responsible lender, I suppose. So in 2021, we were awarded Bridging Lender of the Year at the Bridging and Commercial Awards, and we were delighted to have been awarded that again this year. So it's something I'm very proud to have been a part of, to be able to get this 2 years running. And as you can see, hopefully this kind of gives you an idea of where we're going, and the growth trajectory really of Glenhawk is just continuing from strength to strength, which I think, as we all know what's kind of happening in the market, how important that is. So bridging finance, it basically across all kind of property types. So predominantly these are where we and bridging finance will sit as a whole. So refurbishment, which we will touch on later, especially with what's going on in the market and how things are changing, and where I suppose some investors' focuses are now going to be, rather than retaining properties kind of long term. How that's going to go, who knows how that's going to play out. Regulated bridging finance, residential, which by that we mean kind of your investment properties, so your buy-to-lets, HMOs, etc. Commercial and second charge. So, as I said, what I'd like to do is debunk some of the myth here of bridging finance. Now, I've never met a client that says, I'd like a bridging loan. It's not something you ever really hear. However, I've met a lot of people who would like to make money. So we like to think of it more as a solution, not really a product, but a solution from A to B. And you'll hear a lot of the time, some of these things here. So bridging only has one use. It's too expensive. It's, last resort, or it's all about speed. Now, most of the time, speed is, one of the key elements in bridging finance. It does need to be quick, but actually it's not the case in every single bridging loan. So that's some of the things that I'd like to kind of touch on today. And what we'll do is go through some complications and then solutions, just to give an idea of really why sometimes bridging is first choice rather than last resort, and why instead of kind of trying to shoehorn it down a different route, as to why sometimes it is the best solution. So first of all, auction. So that's, I mean, pretty standard. I suppose anybody who's buying at auction is really going to need to look at bridging finance. There isn't a high street lender or some of the term lenders who can really kind of put the right solution there in place, just because of the deadlines that are there. Bridging is predominantly always going to be the solution if you're looking at buying something at auction. But also it doesn't, you know, with the short deadlines, it doesn't always necessarily have to be an auction purchase. So as an example of one that we did recently was a residential property. The client had brought a grade 2 listed fire damaged property and had taken bridging finance to purchase it. They had now come to pretty much to the end of their term of that finance. Now they had sorted the fire damage in terms of it now being safe, but the property was nowhere near where it needed to be and able to be let out. And the client had 11 days left before the end of their current term. So it came to us and we were able to rebridge that for that client, just to give them the time to finish that off and exit. So although a lot of the time with auctions, you'll always need speed, there are other scenarios where you possibly need that as well. Marketing loan, equity release, or development exits, whatever you like to call them. But again, we're seeing a massive increase in these, and whether that, you know, has been COVID or other things that have affected, we know there's obviously an increase in the cost of materials, an increase in the cost of labour. And it's just meant, and even actually being able to get the people on site is taking a lot longer than it used to. So we're having clients that are coming to the end of their terms with their development finance products, and they're now needing to exit that. And it may be that the property is completely finished and they just need that time. So hence the marketing loan. They just need that time for them to be able to sell. Or it could be where they've still got money that they need to spend just to get that to where it needs to be. So one of these that I was able to assist with recently was actually one of my clients had brought a pub, which they had converted into 5 units. They had come to the end of their term with the development finance lender, and everything was complete. All the properties were kind of wind and watertight, but they hadn't actually got round to doing any internals yet. So it was bathrooms, kitchens, things like that. So we were able to lend off the current value as it was, which enabled them to redeem the development finance lender and also give them the extra just to get that property where it needed to be. And then they've got the time also then to market those to sell as well. So uninhabitable properties, again, that can quite often be something that you're looking at auctions or whichever. But also it could be, you know, off market. Now, I know that whenever we're looking at, well, certainly for myself, whenever I'm looking at properties, which I do quite a lot, whenever I'm looking at properties to move, you always kind of, especially if you're looking at a house for yourself, you're looking at the best properties, you know, going through your Zooplas or your Rightmoves or whichever, and it's the pictures that draw you in. But as an investor, really the ones you want to be looking at is the ones where the pictures, to be honest, are a bit rubbish, or there's not very many pictures there at all, which means that the property is not in a very good condition. So everybody who's looking at those properties to buy, to live in, they're pretty much going to skim over those, but that's perfect opportunity for somebody who's looking for an investment. And that could fall into this category. So if you've got something with no kitchen or no bathroom with any kind of term lender, that's going to be deemed uninhabitable. You can't mortgage it. So hence bridging is a perfect prime solution for that, just to enable you to get it where it needs to be, and then you can then term it out. Or who knows whether, you know, what's kind of going to happen in the buy-to-let market going forward. Maybe people will be looking to do a lot more flips than retaining, who knows, but it still sits as a perfect solution. So commercial to residential conversions. Now, I'm going to touch on this a little bit more in the next couple of slides after this, just because of the huge increase really that we're seeing here. And I think that predominantly is due to the changes that have happened with PD, which hopefully you guys have kind of come across previously. If not, I'm going to touch on it a little bit, but any more information that you want on that kind of afterwards, please don't hesitate to get in contact, and we'd be more than happy to provide. But again, as I was saying, we're seeing a massive increase in these. And I think that, you know, that could be whether you've got kind of a vacant commercial space now on the high street that can be converted to residential under your permitted development, or it can be, you know, your semi-commercials. Quite often in this space, the residential units that are above commercial are really large. So we see quite often where somebody will then look to convert that one property into two. Maybe they're going to keep the commercial on the ground floor. Maybe they're going to look to convert that as well. Who knows? But when you're looking at these, I think with the commercial as well, is that there's a baked in profit already there. So if you're purchasing a residential property as an investor, whether that property is, vacant or it's tenanted, the value is pretty much the same. Where you're buying a commercial property, if it's vacant, you're going to be picking that up cheaper than you are a leased commercial unit. So then if you're then buying, a little bit cheaper than it would be, and then you're then able to convert that under permitted development to residential, there's an immediate profit there because it's now a residential unit, which means, the value will be slightly higher. So high demand on unique opportunity. Now, I think that, again, we saw kind of a huge increase in this, especially where we had that time in the market with stamp duty holidays and whichever, and, properties were selling before they even came on the market. But it just enabled a lot of people to be able to behave like a cash buyer. And even now in this day and age, you'll see some really good opportunities that come up, and they just need to complete that quickly. And you'd be surprised at the amount of people that say that they're cash buyers when in actual fact they've got bridging finance behind them. But it just allows them to be able to act like that and complete within these short timescales. Chain collapse predominantly sits more really in probably the regulated space. It can obviously be in your commercial, unregulated as well, but usually that's where, a client has brought a property or buying a property, a new residential home, and they haven't been able to sell theirs yet, or maybe they have sold theirs and it's fallen through and now they're at risk of losing the property they're buying. Now, when it comes to regulated bridging finance, it is a lot more transactional because it is literally that means to an end to be able to get them to their next home. Whereas, and again, probably, like you say, more of a last resort. Whereas when you're looking in the investment side of bridging finance, it's deemed more of a first resort because it's an opportunity, a way for you to make money or save money effectively. Now, as I mentioned, we touch a little bit just on the commercial to residential conversion. So I've just kind of just put this slide together to give an idea of now which fits into the Class E. And this is where you're able to then look at converting commercial properties to residential properties under permitted development. Now, planning costs time and money. And really the solution to that is being able to look at something under PD. And this is just a simplification really of previous class usage. The government had said that they were going to build 300,000 new homes a year. And obviously that's kind of continued to fail. So this was a way of them finding some sort of solution to help towards this, where you've got a lot of vacant commercial space that isn't being used, with your likes of Amazon and eBays and whichever now, not as many people are needing possibly retail units, or maybe they just need small shop fronts and they've got the opportunity to convert the back into residential just to make the most out of that security. But also not everybody wants to live in a new build property. So it then gives obviously people more opportunity, more homes are available for what's needed. And I added this slide in as well, just because I found this really interesting. And I think that this is even more relevant with kind of what's happening in the market, whichever at the moment. But in 2020, 11% of bridging loans were for refurbs. By 2021, that had increased to 13%. And it's expected that by 2026, this will be £4.6 billion of the bridging market will be in refurbishment. And I think that with, like we say, what's happening at the moment in terms of the market and whether people are going to be looking to, buy your standard residential properties to let out and term on buy-to-let mortgages, who knows how that's going to look. We know that obviously the yields aren't there, the cost of finance is going up, and maybe people are going to start looking at different scenarios, different examples. Maybe we're going to see more flips, we're going to see more refurbishments, more conversions in this space, who knows. But I definitely think there will be some sort of changes there. So back to some more of kind of complication or solutions debunking the myth of bridging finance. So discounted purchase prices. Now, we'd all love to get one of these, and they, unfortunately there isn't masses of them in the market, but they most certainly are out there for our clients to find. And usually that will be if something's kind of purchased before it goes to market, or it could be where a client is a tenant. For example, I came across, well, we did one recently here at Glenhawk where one of the clients was trading from a commercial unit in Weston-super-Mare High Street. They'd had a lease there. They'd been a tenant in place for sort of 6 years. Client had now, the vendor, had decided, landlord, that he was now going to sell that property, and he gave the opportunity for that client, seeing as he'd been in there for so long. Value was 600,000. He gave them the opportunity to buy it for 500. Now, where we'll work off valuations of properties rather than the purchase price, it means that we could maximize that. So we go to maximum of 90% of purchase price, but just enable the client to get more out. And then what can happen is, obviously, after sort of 6 or 12 months, however long the client needs, he can then term that out on the high street, or maybe another specialist lender, whoever fits right for them in that space. But wouldn't have necessarily been able to do that on day one because they would have focused on the purchase price rather than the valuation. Planning delays. So this can be land with planning. It can be residential, commercial, any property that's kind of got planning, but they want to make some sort of amendment. Maybe it's not exactly what they want. So I had a client who was buying a piece of land up in Manchester, and it had planning for 6 semi-detached units, but the client wanted to actually go for amended planning for 6 detached units. So we were able to help them to purchase. They've got the amended planning, and then at that point, they can then exit us out onto development finance. So again, bridging was the perfect solution in that scenario. Gifted deposits is exactly what it says. So in bridging finance, generally you'll tend to find, certainly for ourselves, we're a little bit more lenient on where that can come from. So the deposit could be gifted from family, friends, or even the vendor, which we've done a couple of those recently. I've also had one of an auntie. Whereas again, with your long-term lenders, there's a few more stipulations around that when making the purchase, but they'll be happy to refinance that out at a later date. Non-standard construction, pretty much exactly what it says on the tin, especially with all these new eco homes and whichever we've got coming out. Properties that sit outside of traditional lenders' appetite can sit really nicely with bridging. Maybe they're then going to make amendments to or refurbs or whichever to that property, or maybe then it just gives them time to find that specialist lender to take that out on a long-term solution for them. Adverse credit, exactly what it says, and non-UK nationals as well. So couple of key facts really about ourselves. So we don't charge any early redemption fees. You get direct access to an underwriter with Glenhawk. So if you've got any application that's in, it allows you to pick up the phone or send emails directly to the person who's actually underwriting the case and making the decisions. As I mentioned, you can borrow up to 90% of purchase price, and arrangement fees are up to 2%. The other thing I'd just like to kind of mention to yourselves as well, in terms of your checklist, I suppose. Now, anybody who's placed bridging finance, whether you have or you haven't, you may already have kind of a checklist of what you're looking at when you're looking at placing it, or maybe you are going to create one if it's something you're going to be looking at going into. Now, you'll have obviously, your standard things on there, like your deposit. Have they got the money? Where's it coming from? But exit will obviously be massively key. So nobody wants, any client to be stuck on a bridging finance loan, as much as we don't want any client stuck on a bridging finance loan. So obviously your exit is super, super key when placing any bridging loan. But something that I'd now say is probably a good idea for you to kind of add to your arsenal when looking at that checklist is, does the lender that you are using have the funds to complete the deal? And unfortunately, in the position that we are in at the moment, that is now something that has to be considered in this market. So I would just say that it's something to kind of add on to that checklist and make sure you've got the confidence with that lender you're using that's able to fund that deal for you and see it through to completion. That's it from me. So thank you very much for listening.
Thank you, Samantha. Very, very good indeed. Excellent. I'm not sure. Sadie has actually put something in. I'm not sure if it's a question or if it's a reminder, or it just says Glenhawk equals 90%.
So, it does.
It does. So if that was the question, then that's correct. Yes.
Yes. 90% of purchase price.
Okay.
Yeah.
We've not got any questions yet, or someone is typing, but I'll just the ones that you've actually set yourself. So what are your USPs?
Okay. Yeah. So anybody who actually knows me will know I am not a fan of the word USP at all. In bridging, and the reason why is because I think that if you kind of go around, when I first came into bridging finance a few years ago, And I stood in a room with probably about 10 bridging lenders actually at an auction house. And I heard somebody walking along saying, what are USPs? And everybody's like, oh, we're fast and flexible, we're fast and flexible. If everybody's fast and flexible, it's not a USP, is it? And I think, to be honest, if it's not fast and it's not flexible, it's not bridging finance. So I would actually say bridging itself, in itself, is the USP. It's more about what can that lender, I suppose, do maybe slightly differently. So some of the things I would say in terms of that for us is where we're looking at valuations. So we'll go, like we've said, off valuation rather than purchase price. We always work off open market values. So we don't use 180 or 90 days, like a lot of other lenders in the market. The relationship kind of piece that you get in terms of dealing with the dedicated underwriter. So you've got direct access to that person who's making a decision. And all of the AIPs that Glenhawk issue are credit backed as well. So what you get on that AIP is exactly what you're going to get. It's not, back of a fag packet piece of paper that somebody has just kind of quickly flipped over. That's where I'd say the key part is.
Okay. Sadia's come back with another question, which is minimum land value or property value?
So we've got a minimum loan size of 250,000 on unregulated and 150,000 on regulated. So it's not the property value, it's the loan size really for us.
Okay. Another one of yours, someone else is typing, but another one of yours. What do you see happening with rates in the bridging market going forward?
Oh, do you know, I set myself this question
before.
Yeah. I think, to be honest, it's crazy that at the times we were in are unprecedented. I think that, to be honest, a lot of the kind of term lenders reacted a lot quicker than maybe more the commercial and bridging space. I mean, obviously, we all saw what happened last week, and I've never felt so much for you guys and brokers as to what you had to go through with rates being pulled left, right and centre. But I definitely think that the bridging market is going to react. I think we've already started seeing that there are changes to rates and people pulling rates and then coming back with fresh ones. It is going to happen. It's going to continue to happen. At the end of the day, most of these bridging lenders, well, not most, everybody who's, lending the money, the cost of funds has gone up. So that cost has to be passed on for lenders to still be here in sort of, 12 months time. And it'll be interesting to see what happens with the next base rate rise. But as that continues to go up, so is bridging.
Okay. Mohammed has asked, do you do a regulated rebridge?
Yes.
Good. Which also means you'll do a regulated, a rebridge of a non-regulated deal as well.
Exactly. Yeah, we're absolutely fine with rebridge. Yeah, no problem.
Okay. Paul has asked, gifted deposit to allow the tenant to buy their rented property, gift from landlord, 100%.
Okay, so give the tenants by the rented. Okay, so it's going to be regulated because they're going to live in it. Yeah, we can look at it. Certainly, we'll obviously ask on the scenario, because usually something like that, we just need to check if they're gifting the whole deposit. Is it an arm's length transaction? So are they buying from a family member? If so, then we can't. But it depends on the scenario around that. We quite often see them in this scenario where they're kind of delaying the deposit. They're doing deferred. So for now, it's gifted and they'll pay them at a later date, things like that. But it is something we could look at. But yeah, it will just depend on the circumstances around it, to be honest.
Okay. I've got no more questions that you asked, but there is somebody else typing. Just to let everyone know, we've got packager status with Glenhawk, and also, as always, try and get across quite a few of the hierarchy within Glenhawk as well. So it's not what you know, it's who you know sometimes, as we all know in this business. So put your cases direct or come through us, you still earn the same, and we take all the aggravation away from you, pretty much. So just keep that in mind. Mohammed's now I've got a client from West One, cannot pay on time. West One went to court and court gave 90 days to complete. Is that something you can consider?
Again, it depends on the scenario around it, but to be honest, I would say that's probably a stretch too far in terms of the adverse for us. We are quite happy to look at adverse, but if that I approached your team for and they said they can't accept rebridge. We can accept rebridge. I don't think the rebridge would have been the issue. I think it would more be the situation with West One. If they've taken kind of court proceedings and whichever, then it is a stretch too far for us in terms of the adverse side, not the rebridge. That wouldn't be what the problem is.
Okay, Mohammed, I think we might have a home for that. Just so maybe contact us after, or contact me after today's show, after 1 o'clock. we can see what we can do on that. But there are some lenders out there. One more person. We have got 5 minutes still allocated to. Oh, you got a CCJ for parking. There you go. It's not my son-in-law, is it? By any chance?
We're okay with CCJs as long as they're satisfied before completion or on completion. We can consider CCJs, so that wouldn't be the issue. I think it's probably more maybe the scenario around the West one. I mean, if you want to send it, Mohammed, if you want to send it over to Tony, and obviously Tony's, like you said, he's got somewhere to place it, but he can also send it over to us. I can have a look at it, but I think that it probably is a step too far if they've taken kind of proceedings already to take the property off them. Yeah, that's fine. I can put my email address on here.
Okay, Sam. Thank you, Samantha. Sorry, I've been told not to call you Sam. Samantha, thank you very much indeed. You've done us proud. You're 4 minutes ahead of time, so that means we've got a little bit of time in the bank just in case. Simon will remove you from the room as a speaker. Otherwise, you might close us down completely. So it's happened, believe me. Right. Okay. So we'll move on to our next speaker. Right, everyone. So change of plan. We now have Nathan Waller from Family Building Society. Not met Nathan before because our BDM is on holiday, or I'm not sure.
She's got another all-day event today, so it'll be tricky for her to talk to you and the others at the same time. It's a very busy day.
Okay, so everyone, you should have received this on email this morning, which is Family Building Society's Why Choose a Family Building Society leaflet, which is somewhat unusual but very, very good. So please have a read of that. Give me an idea exactly what Family Building Society does. Just before I introduce Nathan and a bit about him, we are again have packager status with Family Building Society. So when fixed rates come back, which I don't think they have yet, I'm pretty sure they haven't, but when they do come back, we'll have access to rates that you can't get direct. So just take that into consideration, and they will be back very shortly. I mean, they've been around for 150 odd years, I believe. So I don't think they're going anywhere just yet. So a little bit about Nathan first of all. He's worked for the Family Building Society for 5 years. He was previously a mortgage advisor for a large, well-known estate agency-based brokerage. In his spare time, he enjoys spending time with his other half and their dog, finding new places to walk and eat. He also enjoys the odd track day or two on his motorbike. Now, it's interesting fact. I thought he didn't actually tell us too much about him. So I searched the internet, as I always do. So he did. His interest fact was he's an avid motorcyclist. This is all I could find him, but I didn't have a lot of time. So I actually found that when he was growing up, he wanted to be a vet. He's always had dogs in his family and felt it'd be something he'd love to do. This is actually you, Nathan, isn't it? I just want to make sure I'm.
Yeah, it is. Yeah.
Good. However, biology wasn't his strongest subject, but as it turned out, he's found a career doing something he really enjoys. So apologies for that. If you ever present for us again, I'll find something else. Believe me, I will find something else just to spice things up a little bit. So. Over to you. Again, I appreciate you being able to step in for us just while we go and sort Charlie from HTB out. Okay, with a club possibly or something. Right, over to you. I'll see you in about 20 minutes.
Okay, see you in about 20 minutes, Tony. Thanks for that. Okay, so thank you very much for joining us, people, and appreciate you taking the time. As Tony mentioned, we're not there with fixed rates at this moment. We will be returning. When exactly, we're not quite sure, but we definitely will be. And one of the things that's worth considering at this moment in time is because we aren't available with fixed rates at this moment, and quite a lot of our fixed rate products are through our packager distribution, so interest only fixed rates, 5-year fixes on buy-to-lets and things like that. What we are offering is a switch to fix option, that if you have a client that does a mortgage on our discounted variable rates at this moment in time, if it completes by the end of this year, they will then have a 6-month window within that time frame in order to switch to a fixed rate, with no additional charge, no ERCs or anything like that. Also, don't forget, if we do release fixed rates in the meantime, there's nothing stopping the case still proceeding as it is on our discounted variable rates at this moment in time, through the guys at Specialist Hub. And then when we do release them, I'm sure they'll let you know what products have become available. And then you can have that conversation with the client and say, right, you were applying for this product, the fixed rates are now available. What would you like to do? Do you want to carry on the discounted variable rate, or switch to the fixed rates that are currently available that have recently been launched? And because you've already submitted the case through the Specialist Hub, you'll be able to switch that without any additional paperwork, generically speaking. As long as there's no physical changes to the case, like they're borrowing additional money or anything like that, we won't need anything else. We'll just need to switch it over from one product to the other. So that's worth bearing in mind, that the case can still fit with us, still can proceed, and you can always switch it during the underwriting process. Okay. So, as an idea of our kind of general criteria and what the cases that we'll be looking for, we use Equifax and Equifax alone. We look at clients with low or no score, so that's generically the type of clients that may not have much of a credit profile, not borrowed a huge amount. We're seeing an increased trend in clients returning from abroad, where they may have been living in France for a couple of years and actually coming back to the UK to be closer to their family again, and they may not have a huge amount of footprint in the UK. That's not going to stop us from lending. We also don't mind the occasional missed payment on a credit profile. Now, that's not to say we are an adverse lender, but the occasional missed payment on a mortgage we can look to consider. The occasional missed payment on a loan or a credit card we can look to consider. Satisfied defaults up to £500 within the last 3 years we can consider as well, and IVAs and bankruptcies, they need to be clear for 3 years. So although we aren't looking for squeaky clean, we obviously want as clear as credit search as possible, and we can consider those clients have had a couple of issues. Especially at this moment in time, a lot's happened in the last couple of years, so things do happen. Life does happen. Life does get in the way. Significant life events do impact people, and it doesn't necessarily mean they are a bad customer. Obviously, you can always provide a copy of the credit report to the guys there, and we can always do a check with it and just make sure it fits our policy and criteria prior to anything else as well. Okay. Now, where we will probably look to pick up cases is, yes, we will lend from your clients from age 18, like most people will. We'll look at earned income, we'll look at guaranteed allowances and things like that. Where we really kind of come into our own, we're one of the few lenders that will consider salary and share of profit after corporation tax. Just because your client took a 20 grand dividend doesn't necessarily mean that that's all they could have taken. They might have been 100% shareholder of their company. Their business may have turned 60 grand's worth of profit, but they only had a 100 grand mortgage. So they didn't need to take 60 grand's worth of dividends. So they didn't take it. They didn't pay the tax on it because they didn't need to and left the money in the business. What we will look at is the last couple of years worth of salary and share of profit and base the affordability accordingly. Obviously, one of the main things at this moment in time is COVID grants, what we can and can't take. What we are trying to do as much as physically possible is try to ignore the middle year if we possibly can, especially when a lot of businesses were helped and supported by COVID. We're beginning to see more and more businesses now where they can provide their most recent set of accounts that's after the pandemic, and we can look at pre-pandemic, post-pandemic, and then hopefully look to maybe ignore that middle year as long as we can put a reasonable justification behind it, which on the most parts we can look to do. So we can always look at a set of accounts and base it accordingly. Contractors, we look at those 48 times 5 with a minimum income of 30 grand based on that calculation. So we're quite comfortable with those types of clients as well. Joint mortgage sole occupier is becoming more and more popular. It's one of those products that's kind of found its own niche in the market because of a multitude of different things. Cost of living going up, salaries are relatively stagnant. Maybe people had to reduce their hours with their job or go to a completely different career path because what they used to do, it was no longer financially viable, or their business shut down, or a lot changed. Or they may have separated. They may have gone their separate ways with their partners, boyfriends, girlfriends, or it might even be the other way around where people have retired earlier than they anticipated. And actually their income that they're on in retirement doesn't necessarily fit an affordability model. So we're finding that's becoming quite an increasing trend of parents and children helping each other out, either to get onto the property ladder or to keep them in their home by assisting them with affordability. For us, it's for children and parents only. They don't have to be a certain profession, and we can allow up to 4 applicants on a mortgage for this. The only restriction really is for parents and children, and there's a maximum of 2 people assisting the owner or occupier. So if there's one person living in the property, we can only have mum and dad helping. we can't have mum, dad, and maybe stepmum or stepdad's assisting. So it's only limited to 2 people helping out. Okay. But that normally leads on to the next question of, well, that's all very well and good that you allow parents and children to help each other out when it comes to a mortgage, but what can you really do when it comes to their incomes? Now, we are very, very strong in the lending into retirement market. We do a huge amount of business for clients that may be that little bit older, that have squirreled away, put money in the background, they've got good pensions, they've got good investments, they may have made the right decisions in buying a buy-to-let portfolio and keeping that running. We will consider your clients up to the age of 95 at the end of the term. Now, by doing that is we're not necessarily taking earned income past 70 or 75, but we will be looking at state pensions, private pensions, investments, rental income, SIP or flexible drawdown facilities for pension funds, as well as SASs, which kind of falls into the limited company director side of things. Or they may have been a limited company director in the past, ran their own business, that's now passed down to their sons and daughters and they run it for them, but they still have a shareholding in that business and are eligible to a profit share. In that case, we can look at that income all the way to age 95 as well. So this really kind of comes on to the family side of lending, where they can really help out, they can really assist and pass on that intergenerational wealth, either by income or their investments and assets. They don't have to physically draw it, they just need to have the ability to draw on it if need be. So it's a really good way for them to assist in either keeping their own home or to assist the parents and children as well on a joint mortgage sole occupier basis. So we are happy to lend, generically speaking, to age 95 for a client with all these different kind of income streams. And that normally leads itself onto interest only as well. We are extremely well versed in accepting interest only cases. We consider up to 80% loan to value if they already have a suitable repayment vehicle in place. Now for those, what we are looking for is buy-to-lets. If we're not using their pensions or investment funds to support the mortgage affordability, we can utilise that as an exit for the property or for the interest only loan as well. Not everyone is fortunate enough to have a portfolio of 3 or 4 properties behind them that they could sell and pay their mortgage off. But they might have their castle that they're currently in, their one and only home. They're really where they want to live in for as long as possible. But if need be, they could facilitate a sale and downsize, where they could sell their property. They would have enough equity available to go and buy themselves a 1 or a 2-bed flat or whatever would be suitable for them to live in, if push comes to shove at the end of the term. So for that, we will accept it up to a maximum of 70% loan to value, and it's done on a feasible and reasonability check. What we are really looking for is, does that make sense? Where they're living today, could they downsize and buy a 1-bed flat or a 1-bed retirement property for £130,000 worth of equity? If that's a yes, and there's a suitable choice on something like Rightmove or Zoopla, and you do a search and there's 10, 11 properties available within the area that they could buy, well, of course, that's reasonable and credible. So why not? They might also be moving further afield. So they might be living somewhere in the country and moving up, down, left, right, wherever they need to be because they're going back to their grandkids. That's fine as well. So tell us the story and we can look to accept it, as long as, once again, we do a quick check on it and it seems to be reasonable. We do a huge amount on the interest only side, and we tend to do a lot of it on a short-term interest only basis. Now, what we look at is 10 years or longer. We will stress your case in exactly the same way as we would for a normal capital and interest mortgage. So for an 11 or 12-year term, the affordability is probably going to be hampered ever so slightly because the amount of money we need to set aside for a mortgage payment based on a repayment style mortgage is quite high. But if they want a 10-year or less term, we're happy to take it on an interest-only basis and go up to potentially our maximum affordability, which is generally around about 4.5 times income. Now, the reason we can do that is because what that does, it forces somebody to review their circumstances every 10 years. What we shouldn't hopefully be getting is somebody who takes a 30-year interest-only mortgage with us again, and then 30 years down the line go, I don't know what I'm going to do. At least every 10 years, they'll have to review their finances. And there's nothing stopping us lending to that client again after that 10 years is up, as long as obviously they're old enough, young enough for us to consider them for a new mortgage. Okay. Now, generic, that's our main parts on the residential side. We do offer fixed rates, and well, they will be offering fixed rates on the interest only side as well, specifically for our packaging partners, so do keep an eye out for them. I'm going to go ever so briefly into our buy-to-let area. We look at buy-to-lets up to 70%. Normally, we would be stressing on a 5-year fixed rate. So once again, once they become live, we'll be able to look at those. We don't have a minimum income, and we go up to 89 at application. We don't stress a background portfolio, and we will consider multi-unit freehold blocks. We do limited companies. Our main kind of caveat to that is that if they don't want to put personal guarantees in, we will limit the loan to value, and we can consider up to 8 directors. We are also a lender that will consider mortgages for your expat clients on an owner-occupier and a buy-to-let basis. If it's on the owner-occupier side of things, there are a multitude of different countries that we can accept. A few of those are restricted in regards to kind of submission routes as well, and whether they work for a multi-unit, multinational company or not. But generally, what we are looking for an owner-occupier case is an employed client. We will assess their income, and we'll do a stress on the currency. It will need to proceed on an interest-only basis as well, but we can look to consider those. And for a buy-to-let, we can consider it for an expat as well. Okay, I wanted to really mainly focus on our residential side today, because I think especially in this kind of growing and changing market, family assistance and interest only and later life lending is becoming more and more popular, and it's certainly a growing area of the market, and I think we are one of the best at it. I can see there's a question that's come up. Tony, I don't know if you want me to jump into that, or if there's anything else you want me to cover first of all. Fine. So in regards to the limited company buy-to-let, one of the directors is discharged bankrupt in 2021. So no, our same criteria will apply across the board. So when we're looking at things like that, as I said, when we're looking at our general criteria, bankruptcies and things need to be clear for 3 years. So in 2021, we're a little bit too. Oh no, sorry, it's a discharge bankrupt. No, so we're still a year too late. Any other questions from anybody?
We'll cover the question. Sorry, I didn't come back last time because someone parked outside my office. The guy was about 70. Listen to house music, believe it or not, full blast. So all you would have got is this thumping, thump, thump, thump music going on in the background. But leave the questions to the end. I think.
Is that why you've turned your camera off, because you're dancing around to it as well, Tony?
There's no dancing going on. There's no dad dance or granddad dancing going on. But yeah, it's now stopped. So he's now driven off. God knows. Honestly. All right, so you crack on. I'm not sure where you're up to, unfortunately. So
no, that's fine. So Mohammed's asked a little bit more about interest only. So depends on really what you want to know, Mohammed. By all means, type a question in the chat, and I can hopefully kind of explain it in a bit more detail. Any minimum income? No. So the most important thing for us on an interest only deal is it affordable? Now, we're not going to be basing it necessarily on just the interest only payment. It's a full affordability basis. So what we are looking at is it affordable? We don't have a minimum income, because just because somebody wants a 50 grand interest only loan doesn't necessarily mean they have to earn a certain amount of money. You can normally afford that on an affordability basis, which is all available via calculators and bits and pieces. They could have a 25 grand income. That doesn't mean that a 50 grand interest only mortgage isn't suitable for that client. Really, it's based on that actual client's circumstances themselves. So of course, not a problem at all. So no minimum income. It just needs to be affordable when we do the calculations. Credit profile, exactly the same credit profile applies. So when we are looking at things like that, all we'll really be looking at is, have they maintained their debts? As long as they haven't got a huge amount of missed payments or anything like that, then we can look to consider. If they haven't got a huge amount of debt or never really borrowed anything, that doesn't mean it's a problem either. So the most important thing for us because we are based we are a manual underwriting lender, is there a reason? Why would we say no? That's really what we're looking for. Is we look for a reason to consider it rather than for a reason not to. If there's not a huge amount on the credit profile, okay, there's no reason for us not to lend. Why not? The only thing would be is if we do a quick, when we get the bank statements in, if we can see they're going over overdraft limits, missed payments on that, or they started off with £500 overdraft limit in the last 3 months, that's gone to £3,000, we would probably be a bit concerned as to whether putting them into more debt is the right thing to do. But generically, credit profile we're fine with. Buy to let, ideally, yes. We want them to be an owner-occupier on the majority of cases. The only time we can get around that is expats. They don't have to be an owner-occupier for that because they're not always owning abroad. They are sometimes with their employer or renting. So we won't have that restriction for an expat deal, or somebody who might have a significantly large portfolio. If you've got somebody with 100 properties in the background and they want to add to that, is there really a risk to us of them living in it? Probably not. So we can look to consider that on a case-by-case basis.
Sorry, Nathan, I wasn't sure if you'd actually, only because like Grandad, whatever he was, with his music outside, completely threw me. So I was like, glaring at him.
That's all right.
Turn the music down.
No problem.
He was glaring back at me whilst bouncing up and down on the driver's seat. So some people. Yeah. Are we done the slides or?
Yeah, slides are done. There's been a couple of questions which we've answered.
I did hear the questions and everything. Yeah, I'll go to the questions because I've got the questions you set yourself. Because thank you for first of all, thank you for jumping in when you did.
No problem.
Our bacon. And secondly, thanks for the presentation. Very, very good. But Family Building Society always are very, very good. Really, really good. Yeah. And we're really fortunate to be on their packager panel and doing a lot of business with them at the moment as well. So, yeah. And one other thing to consider, actually, not been mentioned, we're on their packager panel, and I will be covering this a little bit later, but we don't charge any packager fees on the Family Building Society cases. So unlike any of our competitors who charge anything between 95 quid and 399 quid, normally up front, we don't charge a penny up front or on completion. So just take that into consideration. When they do reissue their products, which we're hoping is fairly soon, we will issue, we've actually got our own product guides for Family Building Society. We'll send those out to everybody, not just those that have attended today, also the ones that haven't attended today. So everybody that signed up for today will get a copy of that. No more questions from delegates. So these are the questions you set yourself because we have got a couple of minutes. So how do you assess SIPs investments for affordability?
Okay, so the main things we look at when it comes to SIPs and investments is we are comfortable at looking at the fund value. We are happy that the client can draw on as much or as little as that as they potentially want at any given period of time. The market changes significantly on a regular basis, as I'm sure we're all aware. Prices and stocks can go up, fund values can drop and plummet, and then all of a sudden come right back up again. So because of that, we'll look at the current fund value that's dated within the last 2 weeks prior to the application. So that'll give us a rough idea of how much money is in there. We will then take a conservative haircut, I suppose, a little slice off the top to allow for that type of fluctuation in the market. So we'll take 20% off of the top of that. Then we'll look at saying, well, how long do you want to use that fund for? And then we'll divide it over that term for the mortgage. So easy maths, easy figures, because everyone needs that in this time of the morning still. I've had a couple of coffees, but as simple as possible always goes down well. Somebody's got £500,000 sitting in either investments or a SIP or a fully flexible pension fund. We take 80% of that, so that's 400 grand. If they wanted a 10-year mortgage term, that's a potential income of 40 grand a year that we'll look to assess it on. If it's a 20-year mortgage term, then that drops down to 20 grand. So nice and simple and easy to consider it. So what we tend to do is look at finding a way, and this is what we're very good at, is you may be able to tell the guys at Specialist ideally what you want to do, and we will always assess it and say, well, you can do this, or we could do it this way, or we could maybe do it a different way, and we'll try and build the case around that client's individual circumstances. So it may not necessarily fit the affordability on a 10-year, but maybe if we took that down to 8 years, that would shorten that term enough to give them enough income from that pension fund. Or we could say, well, they ideally wanted 10 years, but we might even be able to do it over 20. So how long do they want this mortgage for? We can build it through their individual circumstances. And that's how we look at those types of investments and pension funds. So the most important thing is, can they draw on it if they need to? So if you're looking at SIPs and SASs, then we're going to look at they need to be over 55 to be able to draw on it. The other thing, which I haven't covered on my presentation really, which seems to be coming up more often, are SASs. So if you've got a client that's got a SAS pension fund, that tends to have a property within it. It's normally the property that their business bought or owned at some point, and they either are keeping it themselves or they're renting it out to somebody else, and that's providing them with an income stream. We will take the income that's being generated and their share of it. So normally with a SAS, you'll have multitude of different people in it, or directors or partners that are in it, and they'll have their own specific shareholding. So if that property generated 30 grand's worth of rental income a year and they're a 50% shareholder of the SAS, then we'll take 15 grand. So we can build it around that circumstances as well.
Okay, Nathan, that's brilliant. Thank you very much. And thank you again. I can't thank you enough for stepping in, but
always happy to.
Really appreciate it. Simon will remove you from the room, just in case. Even this is how things are going this morning. I even have a timer on my phone, so I can make sure the time. And believe it or not, the time on the main site on the internet has frozen. So I don't know what's going on today. It's just one of those days, isn't it? Right. Okay. But thanks again, Nathan. We'll catch up soon. Okay. Simon will remove you. Right. So what we'll do is we will come back at 11:25. Just so you're aware what's happening, Charlie will be presenting next. He's got a spare computer or spare laptop. We can be just ensuring that works during the break. We've got one or three options. That's obviously the best option for us. So if you see anything going on during the break, it's because his system's being tested. Okay, he's not presenting. We'll be back at 11:25. Thanks for your patience. Cheers. Okay, so we have Charlie Attridge from Hampshire Trust Bank, better known as HTB, a lender that's been a very big part of our business now since they launched into the specialist market in 2016. I haven't sent you any product guides for Charlie, only because at the moment everything is priced on application. Certainly on the bridging side, on the term side, there's nothing published that I could find on their website. So, but we'll forward that to you once it's come over to us. So Charlie started in the mortgage industry 6 years ago in an admin role for another bank, and has since worked his way up with a lot of hard work and dedication. He started at Hampshire Trust Bank 3 years ago as an internal lending manager. This has helped him gain experience and knowledge of their policy and a great working relationship with his internal team. Since starting his BDM role at the start of lockdown, I'm now talking slower because he's still not appeared in the room, Charlie prides himself on delivering amazing customer service and has built up excellent relationships with brokers that he now works very closely with, including ourselves. And he's still not in the room. I'm just going to check he's actually down as an attendee. If he's as an attendee, no, he's not as an attendee either. Okay. I hope this isn't one of these where I have to do the presentation for that person, because they haven't. It's only ever happened once, and I just about blagged it. But it's saying he's on as a presenter. I've just been told he is on as a presenter. Okay, he's not appearing in my screen. So, interesting fact about Charlie, believe it or not, prior to working in this industry, Charlie used to be a trainee plumber working very closely with a lot of landlords on refurbishment projects. So, no, he's still not appearing. Okay, my team, I believe, might be typing something. So bear with us 1 second, everyone. Told you it's down to outsourced technology sometimes. I'm being told he's on as a presenter. I can't see him as a presenter. And Charlie is in the room as a presenter. He just needs to switch on his camera and microphone. Charlie, please switch them on. Yeah, great. Yeah, there he is. Can you hear us?
Yes, I can hear you. Can you hear me?
Absolutely fine. Perfect. So let's go straight into it. I've already done the introductions. We know you as a trainee plumber, and we know the first bit, so I won't cover them again. But straight on, I'll see you in 20 minutes.
Amazing. Thank you very much, Tony. Well, sorry about the mishap this morning, everybody, but at least we're all sorted now. So yeah, as Tony said, so my name's Charlie. I'm the East Anglia Development Manager at HTB. Today, I'm just going to be sort of going over Hampshire Trust and what we do on our specialist lending side. I'm going to put a bit of a focus on our semi-commercial, but I will sort of be going over some of our other little bits in some more detail as well. So who are Hampshire Trust Bank? So we are a specialist lender with the strength of bank. So all of our funding all comes from ourselves. So it's all of our own cash and heavily led from savings. We fully lend on all your buy-to-lets. We don't do anything regulated or anything like that. So fully for investment purposes, and we lend in England and Wales. And one of the big things for us is we do aim to provide the best service that we possibly can. And we have won the Business Money Facts Awards for best service from a buy-to-let lender for 3 years running now, which is a really great achievement that we do like to sort of mention to people. So what is specialist lending and what does that mean to you? So we try to be as transparent as possible in what we do, and we are a very flexible lender, and try to obviously bring the expertise to the way we do business. And the way that we are very flexible, we have a policy guideline which is maybe like this thick, but then our underwriting manual, which is just guidelines that we adhere to. But if something sounds good, we don't. It's not just by the book. If something sounds like it works and it's worth doing, then I'll be open to a conversation to see what we can do. And as you can see on here, there are lots of different types of things that we can look at, but I'll be going into these a little bit more sort of throughout the presentation as well. So key features for ourselves. So we can lend to a single client up to £25 million. Now that can be over multiple loans or just one single loan if it was sort of a large portfolio. We do have a minimum loan size of £100,000, but we don't have any minimum property value. So clients who may have, let's say 3 properties, maybe up north, only worth £50,000 each, we can still look to consider that on our applications as sort of one portfolio loan, as long as that minimum loan size exceeds £100,000. So generally speaking, we don't have a minimum income requirement. There are a couple of positions there which do, and that's just for first-time landlords and holiday lets. We don't have any maximum age. If a client is turning 75 or is 75 before starting their application, we just need to understand their succession plan, and there may be a few extra little things that we require or need to see, but it is something we're still happy to consider. So across the board, we lend up to 75% LTV, and we are still lending at the moment, given, even in the volatility of the market, we are still offering 2 and 5 year fixed rates. So with the portfolio lending that we do, we don't have any restrictions on the size of a portfolio, whether that's residential or semi-commercial, whether it's the portfolio that we're taking or their outside portfolio. We don't have a problem with the size of that. If it is their outside portfolio, we just need to stress that and make sure that works. And that's a stress rate of 125 at 5, which is pretty standard sort of across everything. And we also don't have a limit to the number of applicants or number of director and shareholders that can go onto our applications. So the types of people that we can lend to, and as you can see for here, there is pretty much most people really. So, your standard SPVs, new and existing, LLPs, individuals, sole traders and partnerships, and then trusts and offshore trusts / offshore companies. When we are talking about offshore companies, it is sort of those BVI jurisdictions like Jersey, Guernsey, Isle of Man, places like that. And that's the same with the trusts as well if they're offshore. With trusts, we just need to understand, who those trustees are and who those beneficiaries are. We would still look to take a personal guarantee on those applications. But it is something we're happy to consider. We would just ask to see that trust deed to understand the exact structure of that trust so that we know who we need as a part of our application. So expats and foreign nationals here. So expats, we can lend up to 75%. There's no limitations, whether it's in personal name or limited company. There is only a very small handful of countries that are flat out no's. but there are most countries we can still lend to, even if it's high risk. So some African countries, Pakistan, India, China, Hong Kong, Canada, Australia, just to sort of name a few, are all absolutely fine. We have sort of an internal risk rating that we work off of, that generally determines whether it's low, medium, high, or if we have to refer the case to compliance. The biggest things with those expats and foreign nationals is understanding their source of wealth and the source of funds that they're using. Depending on the risk rating of the country, we do need to sometimes delve into that quite deeply, but it is something we're still happy to consider and look at. And with those as well, we can consider any types of properties. So we can still consider semi-commercial, buy-to-lets, HMOs, holiday lets, and all that sorts of thing. So first-time landlords. For first-time landlords, we just ask that the clients are owner-occupiers and that they have a minimum income of £25,000. Now, that £25,000 is household income. It's not per client necessarily. So perfect example, if you do have like a husband and wife, both living together in the same house, say wife earns £20,000 and the husband earns £10,000, that would be absolutely fine for us to consider. So for the first-time landlords as well, as I mentioned, we do require them to be owner-occupiers, and I'll go into them in a little bit more detail in a moment. So the types of properties we can lend on, so large and small portfolios, holiday lets and Airbnbs, HMOs, multi-unit blocks, semi-commercial properties. So I'll go into the semi-commercial properties in quite a bit more detail for you shortly. But the biggest thing for ourselves is that we require the properties to meet a 50-50 split. Now that 50-50 split is worked out by the market value of the security or the vacant possession, whichever one we are lending off of. And we need to see that a minimum of 50% of the value is in the residential area or element, sorry. Providing that is the case, then we will be happy to consider that further. So flats above commercial or residential properties that are in the vicinity of commercial, we are okay to consider. It all comes down to, how is it accessed? How good a quality is it? If I get given an inquiry where it's a flat above a shop and the access is, through a dark, unlit alley, past loads of commercial bins and up some metal stairs, sometimes we can struggle around getting the demand there from the valuers, but that's something that will be transparent, from the beginning, and then it's sort of up to the clients as to whether they want to sort of proceed with that. Flats of good quality above 10 stories can be considered, and then low rental yielding properties, which at the moment is obviously something we're coming up with quite a lot, where ICRs just aren't meeting with rates. So we can use income top up. For income top slicing, we can only consider that if the client is UK based and it is a UK income, we're unable to use it for expats and foreign nationals. And we'd also not tend to do it on HMOs and holiday lets, mainly because they 9 times out of 10 would be meeting. And if they're not, there's normally sort of another concern there in the background, given those sort of yieldings on those kind of securities generally very high. And then DSS tenants and serviced accommodation. Now, what I just wanted to mention as well, obviously where we're talking about the semi-commercial today, is that if you do have a semi-commercial with, say, a HMO above or a holiday let above, or anything like that, serviced accommodation, DSS tenants, that is still something we can consider. We can kind of block it all into one to make sure that, that's something we can look at. So I'm gonna skip past a few of these slides. So I'll go on to the first-time landlords a little bit, actually, because with first-time landlords, we can consider first-time landlords for semi-commercial properties, which I know is not something that a lot of lenders do. So same criteria about the income and the homeowner. We do need to see that they have a clear credit history. We would not lend to a first-time landlord if they had poor credit. So the biggest thing for the first-time landlords is that we can only lend up to 4 units. So if you had a semi-commercial with 3 flats above, that's something would be absolutely fine to consider. What we're not keen on for first-time landlords is HMOs and holiday lets, though they can sometimes still be considered. It's going to be a case-by-case basis. We're going to look at things like their income. What has this been running as a HMO previously? Do they have a management agent in place? All those sorts of things are going to come into it. And then we have a maximum individual loan size for a first-time landlord of 500,000 and a maximum overall exposure of £1 million. So we can still do a couple of loans for them. And once they have lettings experience for 12 months, then they would go into our experienced landlords criteria, which would mean sort of no minimum income. We don't require them to be a homeowner and other things as well. So holiday lets, I'm going to brush on these briefly, only because, as I say, they can be considered when it's part of a semi-commercial. So maximum loan size of 1.5 million, maximum of 10 holiday lets that we will look at for the client, maximum exposure of £5 million. Again, they do have the minimum income. Must be homeowners, same sort of criteria as those first-time landlords. And if we're using holiday let income to assist with the ICR, we would require them to be experienced landlords. If they're not and they are first-time landlords, we can still allow it to be a holiday let, but we would only be able to use the AST income to sort of go on that ICR and try and get that LTV up. I'm going to skip past that one as well. So semi-commercial. So this is obviously why I'm here today, and one of the things that I really want to touch on. So again, we can go up to that 75% loan to value, and we do consider a lot of different tenant types in that commercial element. So, your standard ones, so offices, shops, things like that. But then we can also do cafes, takeaways, restaurants, pubs as well can also be included in our semi-commercial proposition. The only things we're sort of not really keen on are more like the entertainment venues or anything with that sort of D2 planning, so things like cinemas, gyms, maybe a mini golf course, something like that is not something we'd be overly comfortable with. But yeah, your standard, what you're going to see, sort of most of the time, 9 times out of 10, it is something that we'd be able to look at. And we would be able to use all the commercial rent as well, as long as there is a lease in place. So experienced landlords, ideally, but as I mentioned earlier, we can consider first-time landlords for semi-commercial, just as long as there's no more than 4 units. So you hear about the extensive range of commercial entities accepted, which is what I just run through. And then, as mentioned previously as well, for the residential sort of elements above, it can be, HMOs, holiday lets, all a variety of different things. So, at the moment, I've got quite a few going through where we've sort of got a shop below and maybe a 5-6 bed HMO above, and then a few studio flats in there as well. The biggest thing for us is just making sure that all of the oh, my mind's just gone so blank. All of the planning, building regs and everything like that is in place. Other things we can do as well. So let's say you had a client that they're purchasing a semi-commercial property and it had planning for the commercial to be converted into residential. So on a term loan, we wouldn't allow them to carry out those works. That's not something we'd be comfortable with. But if they were just purchasing it on the basis that that planning was there, they've got no incentive to carry out those works. We're not gonna, we're gonna trust them on that. We're not just gonna sort of turn around and say no to an application just because planning is there for them to potentially be able to do something. And then, we offer, and then it's a 2% arrangement fee on all of our semi-commercial products. So at the moment, with where the market's at, our new business for semi-commercials is a rate of sort of 8.49, which isn't the most attractive in the world, and that is for 2 and 5 year fixeds and all LTVs and loan sizes. We are hoping that, see, in the next couple of months, the market sort of calms down and rates can sort of start to come back down again. But see, we're in a very, very difficult position at the moment, so we've just got to kind of hope for the best on that. And one of the other things that HTB do offer is a product called a refurb in term. So this refurb in term can be light refurbishment and can be included on, just standard residential properties and also on our semi-commercials. The main thing is it has to just be light works. So nothing that's going to require any building regulations. They're not changing the use, where I mentioned about, commercial going into resi isn't something that would fit on this. But if they just needed to maybe update the flats above or update the commercial with, flooring, bathrooms, kitchens, heatings, electrics, all those sort of stuff that don't require building regulations, we can consider putting them straight onto a term loan. There's no loading of any rates to do that either. We just need to see that the works can be carried out within 3 months. The valuer must confirm that the property is currently habitable and that there is a relet period once the works that have done of a maximum of 3 months. And then we also just need to see that the clients can service the loan for the first 3 months as well from their own savings and their own funds. So I've just seen a question in here about the short lease. So unfortunately, we do have a minimum of 50 years on our leases at the end of a term. So that wouldn't be one for us, unfortunately. If they could get that extended, we'd have to have that extended prior to us lending, given that it's so short, I'm afraid. So as you can see here, we've got some of the sort of list of some of the commercial tenants that we can consider, most of which I mentioned. A few that I hadn't mentioned are these ones at the bottom. So doctors and dentists, surgeries, funeral parlours, and also dry cleaners. The main things with dry cleaners and laundrettes, if they are being included, is we just need to understand if they're doing their dry cleaning on site and they're storing chemicals overnight. If they are doing either or both of those, then we wouldn't be able to lend on that specific element. And the reason for that is just insurance purposes. It's not something that we'd be comfortable with doing. But if we were just lending on the flat above a dry cleaners, then it's not so much of a concern. But if the valuer, goes out to the security and goes into the property and they can smell the chemicals and things like that, then ultimately that can obviously affect their commentary and the demand of the property, depending on obviously the condition it's in and things like that. And that's one of the biggest things that we just need to make sure that we're all okay with. So yeah, look, I mean, to be honest, guys, that's pretty much everything that I sort of wanted to run through today. I think I'm a couple of minutes short, which isn't too bad. But if there's any questions at all from anybody, then please don't hesitate to ask.
I'm just waiting for my camera to click in. So that's great. Thanks, Charlie. Thank you for that. You've actually set yourself 3 questions. You've already answered one. Oh, okay. Dave's asked, what's the current 5-year buy-to-let rates? Dave, it might have changed this morning. Just be aware. You might not be aware.
So it hasn't. So our new business rates at the moment for everything specialist buy-to-let is 7.99. That is 2 and 5 year fix and all LTV products. And then semi-commercial is 8.49 again for all 2 and 5 year fixed and all LTVs.
Okay. Agnes has asked regarding holiday lets, would you accept if it's on a holiday park, it's rented out through Airbnb?
So what it's going to come down to is if there's any restrictions on the title. So if there's a restriction that states it can only be let as a holiday let, then it isn't something we would look at. We do need to see that it could be let as an AST as well. So I have had a couple of before where they've been on holiday parks or, very close to, and they haven't had that restriction. But a lot of the time we do find that is in place on those.
Okay, it's a couple of questions you set yourself. Would you consider first-time landlords for semi-commercial?
Yeah, so I think I briefly touched on that earlier, but yeah, main thing is that they just meet our standard first-time landlord criteria with the being an owner-occupier, good credit, and minimum income of £25,000, and as long as there was no more than 4 units.
Okay, Mohammed's asked, what is the ICR calculation now?
So our ICR calculations vary on what we're looking at. What I can do is send over a product guide to Tony, who would be able to supply that to everybody. But generally, you know, for specialist buy-to-let, it's 125 and 140. 125 for limited company, 140 for personal name. Then semi-commercial is 125 across the board. But then we'll be stressing it at on a 2-year fixed, it would be the pay rate plus 2%. And a 5-year fixed would be just stressed at the pay rate, which would be the 7.99 or 8.49.
And final question: what if the commercial element of a semi-commercial is vacant?
So if the commercial element is vacant, we are more than happy to still consider. We've got no problems with that. We wouldn't be able to use commercial income. You know, if it was a purchase and they had a lease in place prior to completion, so they were moving in, you know, as soon, sort of within a very short space of time of completion happening and paying rent, then we'd still be able to include that. And it's also going to depend on how long it's been vacant for. You know, if it's just been vacant for the past sort of few months or maybe even a year, then we'd probably just be fine. But anything sort of, you know, if it's been vacant for 2-3 years, we're going to be wondering why that is, and sometimes that can impact a valuer's comments around demand in the area. So we just have to sort of throw to the side of caution on those, and be wary that could impact a valuation if there's no one there before completion.
Okay, Charlie, thank you very much. I'm glad we sorted out our IT issue.
Yes, apologies for all that this morning. I'm glad we managed to sort it out.
Yeah, had me frozen a little bit. It doesn't happen very often, but when it does, you think, what am I going to do?
Sorry about that.
Yeah, it was song and dance routine to get everyone entertained. Maybe not. Okay, Simon will remove you from the room. So stay on and watch, obviously, if you wish. And I'll put the next slides on for the next speaker.
Brilliant. Well, look, thanks very much for your time, everyone, and hopefully I'll speak to you soon.
Yeah, cheers.
See you later.
We have Lyam Denney from Selina Finance, and I've just lost my mouse clicker. There it is. That would have been their terms. There was some changes last night, so I removed them, but I didn't remove the slide. So we'll get the Selina terms over to you as soon as we got something in writing from them. A little bit about Lyam first of all. He's worked in financial services for the last 8 years. Initially started in a brokerage as a secured loan advisor. He has worked across secured lending, bridging and development, and mortgage brokering during his time in financial services. Lyam joined Selina in April this year as a broker support manager and has recently made the step up to account manager. Lyam is based between Selina's Manchester and London offices, supporting the currently not so mighty United 6-3, and his true love has always been rugby. Okay.
Oh dear, Tony, you're in a city, are you?
That just came into my head yesterday when I was adding that to the slide about the 6-3. So,
it's all right.
Then I'm a West Ham fan, so I can't speak. Little interesting fact: the first secured loan Lyam placed in his career was while he was based in India. Explain, please.
Before I came into secured lending, I was working at a debt management company, and we were being provided client data from a loan brokerage based in the UK, but ran an operation outside of the UK in India. And I spent 6 months over there with them, working out that operation. And we made a transition to offering secured loan services to consolidate homeowners who had high debt but weren't applicable for debt products. And while there, I was working for Everything Financial and placed my first secured loan. I believe it was when Together was still Blamane.
Blimey, that's going back a bit. Over to you. That explains it. I've never placed a secured loan outside the UK, so there you go. Over to you. I'll see you in about 20 minutes. Looking forward to what you've got to say. Cheers.
Thank you. Cheers. Oh, still good morning, everyone. My name's Lyam. I've just started the account management role with Selina in the last 2 weeks. I've had an interesting couple of weeks. We've had the initial assignment of the role, and then the activity in the market that everyone is all too aware of over the last 10 to 14 days. Just quick content summary of what we'll go over. Please feel free to drop in, obviously, any questions regarding any of these sections that we go over. I'm more than happy to elaborate in any detail as we go through. Brief history of us. We are quite a new lender, only forming as a lender in summer 2019. Our CEO Hubert and our COO Leonard met, combined. Hubert's background has always been finance in the US, where our product is more commonly known than it is over here in the UK, and he's brought that concept back to the UK. Met Leonard and launched Selina Finance. We originally operated as a unregulated lender only, and at the end of 2019 we submitted for our FCA license. Throughout 2020 we continued building in preparation for receipt of the license, so we built our tech platform, we continued our unregulated lending, and then towards the end of 2020 we were granted our FCA license. Summer 21, expanded north, opened up our Manchester office, just down the bottom of Portland Street. Throughout, continued to grow both in London and Manchester. Towards the end of 2021, we'd tripled in size from when we originally launched, and at the back end of the year, we were showing back-to-back record performances. And starting this year, we've doubled the underwriting headcount, looking forward to updated product launch coming at the end of this month. So what are our Selina products? We have a flexible drawdown facility. It is essentially looked at similar to the way you can use an overdraft, or more property related, you could use a bridging loan. It can be secured against your main residence or a second home, as long as this is not an income generating asset. So if you have clients who have houses in the city but live back in the country at the weekends with a family, and on either property we can secure against. You obviously only pay interest on the funds that you draw down, and we have multiple purposes for the facilities that we can cover off in the not too distant future. So our products can be used in two formats. We've either got our home equity line of credit, which we have called HELOC, which is what we originally set up to do. And then we've got our standard term facility that you could take if you took all the funds day one. Essentially what our product will allow you to do is be approved for a facility up to an amount without the need to take all the funds day one, ensuring that you're only paying interest on the money that you borrow. Just at the bottom there, we've got a couple of examples where our facility is very popular. School fees for kids who have got 7, maybe more years of education coming up, as well as stage home renovations. Can't click. Okay, so our product terms at a glance. As Tony alluded to, we were only able to get this over yesterday afternoon. Like many other lenders, we have been affected by the change in the market, as I previously mentioned earlier. As such, we have changed our product suite for the remainder of October. So we will only be offering variable rate products throughout. This is to allow us time to reassess and look at how the market is reacting. We're already seeing positive movements as recent as yesterday from lenders reducing rates and bringing products back, and we hope that trend continues, and it will allow us to bring back the even more competitive products when we relaunch in October, including 2 new items that we've been excited to bring to market but haven't really had the opportunity to do so. Our criteria and basic terms remain unchanged, as highlighted on the screen there, but we're currently starting at 8.75. Just a quick note, like many others, we don't load rates on third charges, and with regards to instant valuations, there is a home track confidence level required and subject to loan to value. We do have a matrix which we can circulate after the presentation for you. So the flexible period and how it works. So providing the term is longer than 5 years, Selina Finance will offer a client up to 5 years to draw down, repay and redraw funds on their facility. The graph there shows a rough idea of how a product will work in an example scenario where you may take a set amount day one and hold funds for further down the line. At the end of the flexible period, the outstanding balance will convert or crystallise, and then the remainder of that loan term will be a standard term product. Now, if a client has not utilised the full net facility that we granted them at the start of the loan, that will essentially be removed, so they're obviously only repaying the facility that they have borrowed. And the quick pointer there at the 12-month mark, it will pay off on full repayment basis each and every month. So the uses of our facility, I've already alluded to school fees. Home improvements and property purchases are probably the two most common scenarios that we see at Selina Finance. The ability to hold that facility without having to make large monthly repayments, certainly for portfolio landlords or investors who are looking to go to auction without the certainty of guaranteeing that they will be able to get that property and not needing to worry about having to repay a facility that they haven't used. They can hold on to that and give themselves ample amount of time. Also, developers who are very into flipping properties have the option to repeatedly use our facility over a period of time. We obviously offer full debt consolidation, tax bill and business purpose facilities. And as I mentioned, school fees are very popular, where children are spending 5, 7, 9 years going through education systems. Having the option to spread out the money that you pay for these fees, these private education facilities over that time, will allow clients a lot more control over their finances and monthly outgoings. Just an example of staging home renovation. I've recently been speaking with Tony regarding one of these cases. I'm sure more conversation at the end will come up regarding how we use our facility for home improvements, but whereby you have a client taking on extensive works on properties, maybe adding, expanding the ground floor space, 2-story extensions or further. They have the option only to pull down the funds that they need. Now, where clients have agreed structures in place with contractors, where they maybe don't have to pay the whole amount up front and they stage their payments, instead of having to pay interest on all that, as we mentioned earlier, they will have the option only to draw down when they require it, reducing the overall amount they will pay on a facility for the term that they're having the works done. With regards to our packaging requirements, so we are very standard in terms of our employed requirements. If your client is in receipt of a standard salary, then we will only require 3 months pay slips. If the client has additional income sources on that pay slip, such as bonus, overtime, commissions, we would request 2 years P60s to support that. And we will use 50% of the average of the last 2 years of any additional income in our calculation. Whenever you key an application onto our system, it will automatically make that calculation for you. So you would key in the full amount of the average of the last 2 years, and we will take the 50% from that. With self-employed applicants, it breaks down a little bit further. Limited companies are always 2 years account certificate, and we will always look to request a projection for the most recent year, including net cash positions. Now, this will allow us to use a recent policy amendment where we can take the most recent year's income, as long as the sustained growth of the company is supported by a projection and certified by the accountants. Where sole trades and partnerships are concerned, we're looking for 2 years SA302s with a tax year overviews, and we will take an average of the last 2 years as standard. Where there is shown growth over a 2-year period that is inside 20% of the previous year, we will use the most recent year. We would always advise in those scenarios that you contact the broker support team who can go through that in more detail. And contractors, there's lots of different contract structures that people will operate in. We generally summarise that we will always want a current contract signed by both parties, and we'll look to have at least 3 months remaining on that before or on the point of completion. If that contract does not have 3 months remaining, we would request a new contract signed by both parties to cover the extension beyond that 3 months period. In terms of our valuation, so we will always look to use Home Track. You will be provided logins to use our Home Track. We can generally offer Home Track valuations up to 80% on most occasions, where the confidence level is over 5. Where you dip below 5, it is always worth just referring to a packing guide, which will follow once we've updated with our new products. Or if you are uncertain, again, always advise contact broker support team or your contact at the specialist hub. They can usually run these home times for you through their access, should I say, when I get those words out, and they will have access to the full matrix to advise you. At this stage, we do not have paper applications or require a direct debit mandate, and we have an electronic ID and verification check process. We use Verif, and we will send a link out to the applicant on submission of an application. They will then have 3 days from that point to take a picture of their photographic ID and the selfie, which then comes back to us and is automatically certified, so we will get notification that that has been completed. With regards to the purposes and the types of documentation we require, debt consolidation is very standard. We'll always look for a signed completed debt consolidation form and with secured debt and in-date redemption statement. Home improvements, as you can see from the breakdown of where we require them, the reason behind the cap at 50k is that most work undertaken under that amount will not require any, or could be done without any contractors present. Above 50k, we would normally assume that a contractor or professional would be required, and at which point we will request quotes issued from the contractors or companies undertaking the work. And we will verify that against the amount requested on the application. Where work has started with any property, we would look to get photos from the client in the initial instance to understand the extent of the work undertaken, and then we would make a decision as whether we require a survey at that stage. It is always best to assume where structural work has started or gone up outside as part of an extension, we would request that. That will allow us to have a surveyor appointed to feedback on any work that had already undertaken. In regards, I've missed a couple of questions. I do apologise. Quickly cover off minimum property value. We're always looking for 100,000 on houses and 150 on flats. A note on flats, we will only lend on leasehold flats, and our minimum lease at the end of the term is 83 years. Moving back to the requirements for home improvements and the survey, you'll appoint the surveyor for us. On application, you can still proceed, and we will still underwrite applications prior to surveys being presented to us. We understand that there's often delays in the surveying field, and we've seen them over the last few weeks where clients are waiting 2-3 weeks to get a surveyor appointed. So we will underwrite an application subject to valuation at that point, and all valuations are reviewed internally by our property risk team as a standard process, and we aim to turn those around within 48 hours. On the rare instance that we are required to contact a surveyor, we will notify you that we're doing so and of the questions that we have asked of them. Where loans are required for business purpose, we will always need to establish the impact that this will have on the client. If they are simply a silent investor and a business continues to run without any operational input from the client, then this will always be deemed an appropriate source. Wherever they have to have a direct influence that could impact their income and their ability to repay our facility, we will begin to ask further questions about how they will maintain their income throughout that period. And if that is set to reduce, we would look to write the loan against the potential reduction in the income to ensure that they can afford it for the duration. So once the initial documentation requirements have been provided and the underwrite has been complete, we will request any further documentation that we may require. This can often be one document or 2 or 3, and there may be 2 or 3 instances where we make further requests. Once that's complete and the case is signed off, we will complete a speaks call. This will be our only interaction with the client. We will call them to confirm any of the loan details, the loan purpose, and the drawdown that they request. We will then provide yourselves with the loan documentation to send to the client. And once the original documentation is received at Pure, they will then check the legal deed is executed correctly, so send the certificate of title, and then we will advance the funds. Now, the last 3 stages will be done same day, and we can wait sometimes up to 48 hours for funds to be dispersed. That covers all the points of the overview of the Selina product that I want to look at initially. I look forward to any further questions that you may have.
Right, just waiting on my camera. Thank you, Liam. This, by the way, I missed part of that presentation. I needed to go to Lou, so
No
I missed
problem.
part of that. Selina's product, I always say this when Selina present at one of our shows, is only 3 occasions in the close on now 40 years that I've been involved in second charges that I've gone, well, that's a game changer. The first one was all the way back in 1997 when a company issued 125% loan to value products, which was an American company. Then we had in 2010, 2011, we had a lender that doesn't have a rate card and everything's scored. So they were the lowest rate they ever had on a secured loan was 2.1%.
Wow.
And then when Selina came out with their product, it really is a game changer. It's something I've been asking lenders for years, is some form of overdraft product. So those clients who don't need all the money up front, they don't need to borrow, in some cases, quite sizable amounts. They don't need to borrow all up front, then pay interest on the full balance. They can draw down as and when they need it. It's a fabulous product, seriously. So
It's it's a steam company that are sat in there, Tony. If you can count on one hand, you know, the game change that you've experienced in the market. So
literally 3 times. So
it's it's a very exciting product to bring to market. And when I initially spoke to Lyam before I joined, and Stacey, I believe, who's done one of these events before, told me about it, and I looked into it further. I struggled to believe that it'd never been had by anyone else previously, and was really excited about being involved with a product that completely redefines how you borrow as a client, because ultimately the end user is, you know, is where we want the best outcome. So for them to have an option where they are not going to be paying additional interest, and the second charge market, you know, there are people that will take out the big term products, but this product is aimed at those who have, you know, or are likely going to be remortgaging in the short term up to medium term. So to give them the option not to have to make additional payments that they don't need to make during those months before that remortgage as well is a good way to do business for them.
And as with every speaker so far, every company that's spoken so far today, we have packager status. Selina don't tend to give out agencies. There's only, I believe, Lyam and Stacey out on the road as such. So they're not really able to sort of service thousands and thousands of introducers and brokers. So we're lucky to be on panel. But the second charge market is slightly different to the rest of the market anyway. So any cases you've got, you know where to come. I think you might have answered the questions that have been asked. Again, I just popped out to Lou. Although
yes, I think I might
Agnes sorry, I'll answer the last one. Agnes has just said, "What is the max LTV for home improvement?"
85% is the max loan to value that we'll offer on all products for all purposes. The only time we're capped at that is where we have listed properties, and we'll go up to 75. And first charge, we're capped at 75% as well.
Yeah, and just also, again, I don't know whether Lyam mentioned this, there's also first charge products and also third charge products available as well.
Yes, we will sit third charge. It is not so necessarily a niche anymore. There are a lot of people doing it, but certainly a status lender offering that is unique. There is definitely the market for it out there, and we do see more and more of it. Certainly when, you know, we're coming off the back of a period where people offer quite competitive products on fixed rates with ARCs, which is a nice point to move on to, as we don't charge early repayment. So it offers another avenue to the market to service a field of clients that maybe haven't previously been looked after.
And just a recent case that we had with Selina, and again, I'll be covering it's not what you know, it's who you know in a little while. Lyam mentioned Pure Law, who are their lawyers.
Yes.
Managing director of Pure Law has been a close personal friend of mine since 1983 when I played football. He was the goalkeeper, I played sweeper. And we've been close friends. He came to my wedding, I went to his wedding, he came to my 50th, etc., etc. I've been mates for years. We had a case recently. Client needed money by the Friday. He was in Portugal for a month. He flew back to Gatwick Airport. I met him at Gatwick Airport 8 o'clock in the morning. Got all the documentation signed, got it all witnessed, got everything done. Drove it round to Pure Law's offices over in Brentwood, or just outside Brentwood, and walked in, spoke to my mate, had a cup of coffee, and by the time I finished my coffee, he had ensured it was on top of the phone and completed. So, yeah, not what you know, it's who you know.
An example of that, Tony, there. Didn't realise that friendship stretched back so far.
Yeah, known John Sims for forever. He's like me dad. Well, not quite like me dad.
Yeah, he's a great point of contact to have. He's always there on the mobile for us as well. You know, when you get a tricky case, you know, land reg is always something that loves throwing a curveball at advisors. When they think they've got a straight down the middle case, you look at a land registry and suddenly something comes up. And he's a great point of contact where, you know, we've needed a very bespoke item looking at for us, and he's just a call away, a fantastic option for us.
And I will normally do that if there is something a little bit contentious. I normally do that beforehand and get his view. Not a lot of brokers have got that sort of relationship with somebody at that level. So
no, absolutely not.
I'll just pop into your questions because I mean I think you've already answered two of them, but just with regards to the further drawdown process. So once the loan's completed and money's been drawn, how do they draw money in the future?
So clients will contact our servicing team. We provide an email, which is myloan@servicing.selinafinance.co.uk, and they make the drawdown request themselves. The servicing team will contact the client, go through your standard data protection process, and then confirm the amount that they require. This is all done and then processed around the 15th of the month, and usually then released within 72 hours of the confirmation that the drawdown has been approved. With the drawdowns, we certainly moving on to the home improvement aspect, where clients are undertaking series of works throughout, we generally don't ask for any proof that works have been completed by the client. We will just allow them to continue drawing those funds down. We do not have a post-completion servicing aspect where we will continue to visit the client where we've appointed a surveyor.
Liam, thank you very much indeed. Of all the Selina presenters so far, yours has been the least problematic. One of Liam's colleagues, this was last year, was presenting from home in her front room, and unfortunately her computer was right by the door. What she didn't actually factor in was that she had 3 Amazon deliveries while she was talking, and also the postman, and also a very, very noisy, yappy dog. So every 2-3 minutes there was a knock on the door. A dog went mental, and she's trying to get whilst trying to speak, trying to shoo the dog away somewhere, and so we're still taking the mickey out of her now. So Liam, if you weren't aware of that story, you're free to.
Oh no! Interestingly, while I was waiting, and Charlie was on the back end of his presentation, there was a knock at the door, and the dogs went nuts. I'd never moved so quickly, Tony, to get to that door to take that package. It was a new passport arriving, so I didn't really want to miss it. But yeah, fortunately, the timing was kind to me. So thank you very much for having me.
No, thank you for speaking to us. Simon will remove you from the room, and we will then continue with the last part of today, which is me. So this is, I always start by talking about what's happened in the last month. I don't need to tell you what's happened in the last month. It's been, what has happened in the last month. I was trying to think of a word yesterday when I was writing this that would describe how the last month has been, and we've all experienced it. If you're involved in the mortgage market in any way whatsoever, we've experienced what it's like. Carnage was the one word I could think of. It has been absolutely crazy, absolutely crazy. I do believe, and I know the reason why lenders have had to act the way they have. I think there's some people in some lenders who should really hang their head in shame, because there's been a couple of absolutely disgraceful actions taking place. I'm not going to say which lenders they are, because I'll probably have the agency in the post. But it really has been disgraceful. You cannot treat people, I'm not talking about brokers, you cannot treat customers like that. You really can't. And we've got still ongoing problems. I mean, I've seen today that the Chancellor is now meeting with the heads of the major banks regarding the mortgage crisis, as it's now being called. Let's see what comes of that. I would probably say absolutely nothing whatsoever. Nothing at all is going to come of it. So we're just going to have to try and ride this out, I suppose. And see what happens, but it's not doing clients any favors, really isn't. We've had one client who had to complete by last Friday, and because the solicitor couldn't get to the deal in time, his rate's just gone up by 3%. So that's a phone call I've got to have with that client after I finish today to try and find a solution, because obviously he's not very happy. The other thing was, I mentioned, I think it was last month or the month before, that there was, Liz Truss had said that she was looking to merge the FCA with the PRA to bring them under one banner because she wasn't happy. It would turn out, from what I've read since, that was a shot across the FCA's bow due to all the basic cock-ups, is probably the best way to describe it, that the FCA have been involved in recent times in the financial scandals, which we all pretty much have to pay for within our fees, although she is intending to complete a thorough review. And I'm also told she's not a big fan of the FCA's CEO either. So let's watch this space, see what happens. But I can see some heads are going to roll fairly soon. So this is a little bit of information. This part is always a little bit of information about us and what we can offer you and what we can do for you. We're very fortunate in what I've managed to build here over the years is something of a hybrid packager, but also advice giver to customers, depending on how you want to work with your clients, whether you want to give the advice, whether you want someone else to give the advice. So that's basically what we are. We're not unique. There's plenty out there doing that, but I just think we do actually do it a lot better than many of those out there because we've been doing it a long, long time. What we offer really is a partnership, and the partnership is about two entities trusting each other and understanding the issues that go on from time to time, especially at the moment. An example is a broker on the phone the other day, very unhappy that the quote that we gave 3 weeks ago, the rate had gone up. Well, if you hadn't spent 3 weeks trying to negotiate with us what the valuation fee was going to be, your client would have got that rate that was 2% cheaper. So it's very much down to, we know what the way things are at the moment. We had a situation last week where a lender issued rates on, I can't remember which day of the week it was, but in the evening. And by the next day, we then got an email in the afternoon saying you have 15 minutes to secure any new rates because we're changing our products. And we had about half a dozen deals to still go on their system. So I had every member of staff putting deals on the system, which then crashed. And one client didn't get the rate that he'd been quoted because that actually was accepted by the lender system 1 minute after the deadline. So we're now in a situation we're trying to explain to a client why 3 of his loans are at one rate and 1 loan is at another rate. And most clients don't understand what's going on. They really have, they can see what's in the press and understand there's some turmoil, but they don't understand what lenders are going through. But just sometimes it's also then explaining that to the introducer or broker partner as to what's happened. So again, it's about trusting each other, but also being aware of what the market is about at the moment. And it is unprecedented. Doing this a long time. I mean, I've seen some problems in the past, but nothing like this at all. I'll talk about our sourcing systems in a little while and the problems we've had with that. But it's been, for all of us, something of a nightmare recently. We want to help you grow your business. We also want to make sure you're still around in years to come. And that is especially probably prevalent because we're pretty sure we're going to be hitting another recession fairly soon. We don't know to what extent. Hopefully lenders are better capitalized this time round and there'll be more lenders staying in the marketplace, hopefully staying in the marketplace. I do worry about some lenders who've got in the way they're funded and whether they will be around in 6 months' time. We'll have to wait and see. Doesn't matter what your FCA status is, DA, appointed rep, exempt professional, we have solutions for your business. If you're not authorised, our PI cover will no longer allow us to accept business that is covered under regulation from you. And if we do decline your agency, we recently had somebody who said the reason we declined it was due to racism. No, it was due to the fact you was on Facebook, had a page on Facebook saying you gave advice when you weren't authorised by the FCA. So there are ways of helping out those brokers that are not authorised, but not in all cases. But contact us if you're not. I want to make sure you stay compliant. That's the reason why we give out GDPR checklists that are not available anywhere else. We want to make sure you're writing business indefinitely. I can't write business if you're not actually placing those cases with us. So I need you as much as I need lenders. So we want to make sure you're still around. Our products, pretty much everything other than equity release, because it's a product I'm not overly keen on, and there's plenty out there offering it. I realise it's a boom market at the moment, especially at the moment, but it's not something we offer. But literally everything else, and we are experienced in all of these. That I can't stress enough. It's not just we've not decided to just move into, for example, commercial mortgages. Been doing them for decades. We've not just decided to move into regulated second charges. Been doing those for decades. So that's our product range, and we do know what we're doing on all of these particular products. And how you want to work with us, either packaged, where you give the advice, or introduced only, where we give the advice. And we treat all cases the same, whether they're regulated or unregulated. We treat them on an advice basis, and we work the same way. Our way of working on non-regulated business is the same as regulated business. We still do reasons why letters, etc., 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 and still we run basically the same process. You decide. So if you decide on one case that you want to basically give the advice yourself, but on the next case you want us to give the advice, more than happy to do that. More than happy. And why are we different? And not the products we offer, because they're pretty much the same everywhere at the moment. We haven't got many things in the way of exclusives. If we have, then rates have been shooting up, so they might not be particularly competitive at the moment, but we do have the odd exclusive, so we offer the same as everybody else. It's the people we employ. And I do speak to a lot of broker partners, and they say they've had experience with other companies, other packages who normally have the name Specialist Finance in the name, and their staff aren't fit for purpose. They've only been in the market for sort of like what seems like 5 minutes sometimes. With us, it's a minimum of 5 years specialist financial services experience, not just somebody who's been working in Tesco's recently, or even working in behind the counter at Nationwide. They need experience in our industry, because I want people who can hit the ground running, learn our processes, but actually know what they're talking about when they come into my company. Multilingual, I actually have added it. We have staff who speak a number of different languages, and I now quite often hear different languages being spoken in the office to not just customers, but also broker partners, which can assist greatly. One reason I've highlighted that mature life experience, that's something that money cannot buy. So all of my staff are, I think my youngest member of staff is in her mid-30s, I believe. And they've all been doing this a long time, and they know how to speak to people. They know how to speak to you. They know how to speak to your customers, should we have the need to do so. They understand what's going on. On the rare occasion that something goes wrong, because we're not perfect, things do go wrong sometimes, they know how to deal with it, but also recognise early that something has gone wrong. And not just hide, let's brush it under the carpet and hope it goes away. They understand it has to be dealt with. So absolutely key. A little bit why we're different, our lender relationships. I already mentioned one person who I know who's the managing director of a legal firm that deals with about a dozen different lenders, but that goes across the board. I've got lender relationships with directors or people at director level with so many lenders that I've known for donkey's years because of how long I've been in the business. And that, again, that can just be a phone call. All right, mate, how you doing? How's the wife? Yeah, we got this deal, blah, 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 blah. Yeah, that sounds all right. Yeah, okay. And that's the way, the sort of relationships that I've got. I don't speak with lender underwriters. I speak with the people that make the decisions, which is useful because sometimes you find lender underwriters don't approach the person who makes the decisions in the same manner. So that's how we work. Our lender relationship absolutely key to us. We take our compliance very, very seriously. We have now had our NACFB third visit, and we came through it with flying colours. So very pleased with that. We take prevention of financial crime very, very seriously. We came across a few during COVID, weirdly enough, but not a lot since. But we are very, very thorough, and we've been told by several lenders and also the NACFB, our anti-money laundering controls are second to none. And it's not our numerous awards in the financial press. Now, lenders today have mentioned winning awards. Quite happy with that. At least lenders can have someone vote for them. When it comes to brokers, who is actually voting those brokers for those awards? Well, here's one. This one was being voted for this particular Mortgage Awards in 2021 by the director's friends on Facebook and Twitter and Instagram and anything else email. You can do it on TikTok, I've no idea. And giving away an Amazon voucher to one lucky voter. Now, none of those people have ever borrowed money through that broker. So how can they be voting for best broker? They're just doing someone a favour. But if you know who that particular company is and who that guy is, he's probably going around at different industry events telling people that he is the best broker in the country. He's not. His Facebook friends voted for him. This was very prevalent. I was a little bit bored during the summer. Well, I went away at the end of June for my birthday. My wife wasn't well, so we couldn't go anywhere. So I saw this pop up and I thought, okay, well, I've got some time to kill. So let's have a look at this particular online publications awards all the way back in June, sponsored by HSBC. And I'm not alleging any wrongdoing has taken place, just so you're aware. But I'll let you make up your own mind. These were the winners. As you can see, I think there's 20 of them there, maybe 19, but possibly I think there was 20 actually. I think there's 19 winners, 20 categories. So they are the winners. These were the sponsors and those that advertise on a regular basis with that particular publication. Only 5 companies won something where they had no sponsorship or advertising or current advertising involved. So 75% of the awards went to companies that had a financial involvement. Okay. And then it came on to these two companies' sponsors. So HSBC sponsored Best Surveyor and Best Network, and Central Trust sponsored Best Second Charge Broker. Okay. HSBC won BDM of the Year and the top award, which is Best Mortgage Lender. That's the one that all mortgage lenders go for, and they sponsored the awards. Central Trust Second Charge Broker Award, Best Second Charge Broker awarded to the Loans Engine, which is a subsidiary of Central Trust. Make up your own mind. I've made up my mind. What else can we offer? Designated underwriters from start to finish, except we've now brought in an experienced person, which is quite often. It's one of my staff, but I'll also get involved as well once a deal has been offered, because some of the stuff that's going on after post-offer with lenders, we need to get these cases through quickly. So we'll put pressure on solicitors, put pressure on lenders to actually make sure the cases are at the top of the pile, just to ensure those cases do speed through as quickly as possible. We pay your commission immediately on loan completion, no excuses. I've always done that. I could give numerous examples. The day I renewed my wedding vows, the day of my daughter's wedding, the day I had an operation last year. I still have brokers to pay on those particular days, and I did so. And there's no commission clawbacks unless it turns out to be fraud or the client cancels the application within some lenders have a 14-day cancellation period. That's the only time we'd actually ask for the money back. And what else we can offer? Inquiries are all pre-qualified. So when you give us an inquiry, one of the first things that we want to do is get a credit search completed on that customer with their permission, obviously, because we all know what customers can be like. Sometimes they're not always particularly truthful. So we just ensure that we know which road to go down right from the start, not be finding out 2-3 weeks after you've introduced the client to us that the guy's got 5 defaults when the lender actually gets around to searching it. We know right from the outset. So we're going down that right road straight away, rather than finding out. And we don't go with what the client actually produces to us, because different lenders use different, like some lenders use Equifax, some use Experian, but certainly when it comes to Equifax, they've got 4 different credit scores. And a client's credit report, that something obtained by the client, is not going to give the credit score that is more likely going to be used by that lender. So very important we get that done right from the start. It's at our expense, soft search, doesn't affect the client's credit rating. There you go. I've just seen someone's actually just put something up, which I'm going to cover in a little while, actually, about the FCA. But this particular part is very, very important. It just means we're not wasting time for days or weeks right at the start. What else we can offer? Now, I mentioned it a little bit earlier about how difficult it's been. Loan quote, commercial quote, bridge quote are 3 quoting systems that we built in-house because we felt that what's out there at the moment is not fit for purpose. I saw Mortgage Brain issued a bulletin recently to say that despite industry coverage, their products were up to date. I went on their system that afternoon and saw that there was a together rate being quoted that was actually 2 bulletins old. So I've not counted how much on Mortgage Brain is out of date, but you can imagine it is out of date. And it is very difficult to keep quoting systems up to date at the moment, because quite simply, you can change something in the afternoon and it will change again the following day. And it's very difficult to actually know what rate you quoted the club. We all know how difficult it is at the moment. But these are our own quoting systems and they are up to date. And we're now investigating ways to put these online on our website. So we're hoping, my IT department's hoping that fairly soon you can access these yourself through our website and get quotes straight away. Data security, very, very important to us. Our data cannot be accessed externally. Unless you've got case tracking, you can see your own cases, but you won't be able to see anybody else's. But that's very, very important. And our second charge panel, not going to read all those out. I need to make sure that they're all still lending. I think they are. Yeah, they are all still lending. But it's everybody in the marketplace, quite simply. In fact, Castle Trust aren't doing second charges at the moment. That's the only one. But it's everybody in the marketplace. I'm now, I believe, the second longest serving person in the second charge industry, continuous, I'm talking about, and since 1983. So some of those, I don't think any of those lenders have been around that long. I don't think they have. No, they haven't. Possibly Together is about the only one. But I've mentioned how long we've been doing this. So we deal with literally everybody on the second charge side. And just be aware that when it comes, if you're using one of the L&G as Mortgage Club or Simply Biz Mortgage Club for your second charges, I think I took this about 6 weeks ago from the L&G website. Of those 4 lenders, Marsthaven haven't been lending for quite some time because they've withdrawn completely from the lending market. Precise haven't been lending for a good 4 or 5 months, but what they were offering prior to that was so uncompetitive they couldn't actually offer anything anyway. Only Shawbrook and UTB. That's L&G. Down at Simply Biz, this one's even better because not only have they got Precise and Marsthaven, but they've also got Paragon, who actually withdrew from the market last year. I think it was beginning of last year. But they're still offering that on their website. It's not available, unfortunately. I wish it was, because they were a great lender. So just be careful if you are going through one of those like Simply Biz or L&G, that you've got access to the whole of market. Well, you won't have access to the whole of market. It's best if you speak with a specialist packager. Our regulated first charge panel, but mainly from that you'll see Family, Foundation, Precise, Market Harborough. We have packager status with those lenders. Central Trust, Together, and Norton are sort of more on the specialist side of things, but we can give you access to those as a packager. When it comes to our buy-to-let panel, consider one. I need to keep checking all these. Some of these may have actually stopped lending temporarily, or we hope temporarily. I think most of them are actually okay. That's our specialist buy-to-let panel where we give the advice. If you want to give the advice, it's down to these lenders. Castle Trust have, unfortunately, as of yesterday, pulled out temporarily from term buy-to-lets, but they're offering bridging. Which I think all of the other ones are still, they are all still lending that I can see. But that's if you want to give the advice. And if you quote these lenders, those 9 lenders, we do not charge a packager fee, upfront or on completion. That doesn't matter what size the loan is either. We will do the work for you. You'll still get paid what you get paid if you went direct. And to give you an example of what's being charged out there at the moment, anything from 95 to, I think I said 399 before, forgive me, it's actually 299. But 299 quid up front for a client with no guarantee it's going to complete is a bit hefty, in my opinion. We don't charge a penny. Our bridging lender panel, advised or non-advised basis, basically covers everything you can think of when it comes to bridging. And again, because we know the people in senior positions with all of these lenders, we're able to get stuff through sometimes that you might not be able to get through yourself. So always bear that in mind. And we have packager status with almost every single lender that's mentioned there. A commercial lender panel, everyone you can think of. I keep looking at these, just thinking what's changed in the last couple of days, but I can't see any of those have actually pulled from the market. It's extensive, covers every scenario you can think of when it comes to commercial. So again, next time you've got commercial has come up, we can quote you within probably a minute with our quoting systems. And if you wish to advise on second charges, I did mention this earlier on about how important second charges are at the moment and how much business is coming in. We can offer you the facility where we do the work for you. We source the products for you. We instruct the valuations. We instruct the consent to a second charge, all on your behalf. And we do not charge a packager fee, upfront or on completion. So you can charge whatever you wish. If you wish to charge £5,000, as some of our broker partners do, you can do. If you wish to charge 395 quid, because that fits in with what you normally charge on your mortgages, you can do. It's entirely up to you. You have the control over the case. Service isn't available for regulated first charge mortgages. I always get a few cases come over after one of our shows for someone saying, oh, these can go with Halifax. Well, it's not really, there's no money in it for us to do that, and really no money in it for you to do that either. So it's not really available on regulated first charge mortgages unless it's one of the ones I've previously mentioned. If you would like to know what we pay, that's now changed slightly. It's now got red dice on the front of it, the one, our latest one. Just enter the word PROC in the type your message below, and we'll get that out to you today. That just lists every lender we deal with and what we pay away, and you probably be pleasantly surprised some of those when you compare them to others. So just keep an eye on that, because there's lots of procs coming up. And beware of the bandits. Now, I've been talking about this since 2018 about some of the shysters in our industry, or some of my competitor shysters, because there was one that we had actually came to our show. But this is one that we found this year, because I asked the broker partner the question, when you did the deal last time, how much did you earn? And this was a £7 million case that was put through a particular lender. And it says delegate there. He wasn't a delegate. He was paid £7,000, which he was told was half the prop fee. That particular master broker, which is a term I hate, their income was 117,000. So they made 110 grand out of that deal. Just watch what you're being paid, because there are some out there who would turn over their own grandmother. They really are. Case study, a few case studies here. We've got plenty of time, actually. So we're going to finish early today, which is good because I haven't got any lunch and I'm starving. So this was a client that we did helped earlier on this year through YBS Commercial. Very, very difficult agency to get, by the way. We was invited onto panel, and the process to actually be approved onto their panel was more stringent than applying for FCA authorization, and that is no joke. They only take on companies that they see that can do the job they say they can do, and they are very, very, very strict. So this was a client purchased a grade 2 listed property in Essex in 2014. There was all sorts of stuff going on. There was loans from companies based in Guernsey. I think there was Panama was mentioned, thinking back. There was all sorts of stuff going on. But it's nice to get those rates now. 3.35 fixed for 5 years over a 10-year term. Introducer got over 12 grand on the day of completion. That's the first one. Second one, this was one that we did in November 2021. The refinance is now going through for before it expires in November 22. This went through Roma, 20-bed property that are planning for a 10-bed HMO. The previous owner had been using it for more than 10 beds. Unfortunately, was breaking lots of rules. But one of the other big problems was that there was a neighbour stealing the property's electricity, which held up some things at the legal side. So we arranged 10-month bridge, no broker or packager fees, introduced rent £21,050 on the day of completion. And we didn't charge any more on top because we're on packager status with Roma. He would have got that if he went direct. Very, very difficult case to deal with, but got it through. And the client was so happy, we're now arranging the exit, which will go through probably the end of this month. Another case study completed on the 5th of July 2022, and by far the most difficult case I've ever that we've ever been involved in, but certainly that I've ever been involved in. It was a situation where very wealthy clients who had certain industry professionals leeching, not industry, but certain professionals leeching off them for years, basically charging them for work that wasn't done. As an example, when we looked at their portfolio of 19 properties, 5 of them had charges that had not been removed all the way back, ranging, I think it was between 2002 and 2006. 2 of those lenders had ceased lending. Trying to track down how to get the charge removed was difficult, to say the least. And the one director over here, there was a director living in the UK, when we would ask him for example, building insurance, he would send for 19 properties, he would send each one over, you send one over, and then call us like 2 days later, what are you waiting on? We're waiting on the other 18. And then he'd send us a demands and needs statement for the next property insurance. It was as painful as that. He didn't know what he was doing, unfortunately. We managed to get it through. I only had to get involved because I had to deal with the solicitor acting for the client, who was as big a joke as I've ever come across. He didn't want to do any work, but he was charging £350 an hour to the client. So we managed to make some changes on that, managed to get rid of him, and then it went through, introduced around 45 grand from the case over the space of 2 days, because we're limited to how much we can pay a day. So 45 grand, and he had no involvement whatsoever, none whatsoever. And what the broker said on Trustpilot, I'm not going to read all that to you, but basically, in a nutshell, he's now semi-retired. And he's told me that if he found us before he retired, he would probably have been able to retire fully from the money he would have earned, because he was using other companies for his business, and they are not a patch on my company and also my staff. And he said, I would have earned a fortune. And he is actually earning now. He's now earning more than he was before he retired. That's how daft it is. So again, I'm not going to read through all of that for you, because, but he said at the top, if I could give more than 5 stars, I would. And this is one that completed 11th of July, which we did a Lord and Lady, a refinance of 18 properties, all in the same village. So you imagine the concentration problems with some lenders that we'll come across, but Castle Trust were happy to accept it. They first came to us in the middle of lockdown, and the clients couldn't understand why, at the ages of 85 and 81, as they were at the time, they couldn't borrow money during a pandemic that was obviously causing the older generation major problems. So we had to get across that, and also because they've been defrauded of large sums of money on several occasions, they trusted no one at all. So it was a very difficult. I would put that was the second most difficult case. That was mainly because of the borrowers more than anything else. But introduced a partner just under 30 grand on the day of completion, which was his biggest. He's a wealth manager. His biggest payday this year so far on any case he's done, and he deals with some seriously wealthy people. And it's not what you know, it's who you know. I'll keep saying this, and I'll keep saying it probably until I retire from this industry. It really is. So this was a case that came to us. Clients ran 2 very profitable children's nurseries. Wife was in charge of looking after the kids' side. Husband did the financial side, and he'd not paid any tax or national insurance on their employees for something. I think it was over a decade. He was finally caught. He found that he defrauded HMRC of $850,000. Was sentenced to 5 years in prison. She was not charged, and because she knew nothing of it. She divorced him, quite rightly so. All assets in joint names, which included the 2 children's nurseries, their home, and 2 buy-to-lets, had a Proceeds of Crime Act charge. Now, if any of you have ever tried to get a deal through as a Proceeds of Crime Act charge, it has compliance departments within lenders rubbing their hands together, because it's one they can say, oh, no, can't touch that. And it's exactly what was happening across the board. Multiple lenders, no reputational risk, can't touch that. Barclays called in both commercial mortgages. Northern Rock first charge on their home went over term. It was a mess, a real mess. So what did we do? It came to us. We did our usual, like anybody else. My team contacted lenders. Would you do this? No, can't do it. And one of the lenders we contacted was Together Money, and it was declined by their compliance department because the underwriter took it there and said, we got this. It's got a Proceeds of Crime Act charge. Oh no, we're not touching that. So case handed to me, signed off as a decline. I thought, this is daft. We've got clients with 300 grand sitting in their business account. Right, they need to raise a significant amount of money to pay off the Proceeds of Crime Act charges, but less than 50% loan to value. So I phoned one of my friends at Together, who's at director level. 10-minute conversation. How's the wife? Yeah. How's your wife? Yeah, fine. How's the kids? How's the grandkids? Usual sort of situation. Gave them a couple of minutes overview on the case. He said, well, I'd like to do that. Why aren't we doing it? And I said, well, your compliance department doesn't want to do it. He said, leave it with me. There's a difference, a director going into a compliance department and saying, why aren't we doing this, than there is to an underwriter. And guess what? Compliance changed their mind. So we then was able to get that through together. We refinanced everything we needed to refinance, got rid of the proceeds of crime act charge, introduced rent just under 12 grand. All of those have now been refinanced away from together back on the high street because the proceeds of crime act charge is no longer around. So the problem has gone. So we managed to get those through in a fairly quick time as well to get those through. Not an easy case to do, but we managed to get through. And that was down to one 10-minute phone call with somebody that I knew. So cases you can't place, type your message and in the type your message box below, the type inquiry, we can call you back. The decision in principle form we sent you this afternoon with a broker pack. There's one for every product. So go to our website, submit something online, or you can call the team. They're ready to take your call. I'm just going to go up the chat in a minute, the messages in a minute, because there's just something I want to cover. If you've received something from me, if you're on LinkedIn and you receive a request to link on LinkedIn, please do so. If you haven't got something, if you're on LinkedIn and you haven't got anything, it's probably because we can't find you. So if your name's John Smith, for example, we might have problems finding you, but you should be able to find me quite easily. I'm pretty active on LinkedIn, so please link with us and we can keep you updated with things that are going on via LinkedIn. No issue whatsoever. I'm just going to scroll up a little bit just so I can see exactly what it was that was said, because it was very, very, it is Paul. Yeah, very, 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 very prevalent at the moment. If you like what you've seen today, this will also be sent to you today. We need an agency application back from you to pay commission, not to receive business. Just be aware, if I haven't got that back by the time the deal's completed, I can't pay you. That's the only time I can't pay you on the day of completion, is if we've not got that back. So if you've got it, just send that back to us. You only got to complete one page and sign it at the back, and it's done. So I'm just going to cover this, actually. Paul was saying he's sick of completing FCA surveys under pain of a fine. I fully believe our job is to look after our clients, not complete surveys. For those of you who are directly authorised, you've probably received the email now that the FCA has decided to continue their financial resilience surveys, which means every time we want to complete one, we have to contact our accountant to get 3-month figures. And of course, our accountant charges us. I really cannot see at the moment why they think these are prevalent when we're completing 6 monthly returns. They now have to do, and I wouldn't mind, but I did, is it the end of October? It is the end of October. I have to complete one of these at the end of October. And I've now also got to complete a financial resilience survey. Our regulator, unfortunately, hasn't got a bloody clue, quite simply. So I'm going to get that off my chest. So next specialist mortgage, our last one of the year is on the 3rd of November. I can't believe how quickly this year has gone. Someone's actually just asked how to register. You are registered. If you're on today's show, you have already registered with us. Say all you need to do to be able to place business with us is to complete the agency application form. So I just saw that in amongst all the PROC requests. So this is next month. Interbay, MFS, Pepper Money and Shawbrook are presenting, covering, again, 4 different types of products. So please tune in. It's our last one of the year. We're now busy organising next year's. Hopefully we've still got an industry to actually present to. I'm sure we will. When you leave today's session, you'll see in the top right corner, you've got an event board little box. It probably has your initials next to it in colour. Just click on that and then click exit event. Your feedback form will appear straight away. If you just close your screen down without doing that, then you won't get the feedback form, and also the CPD might be delayed as well. So the CPD will be done after that will be emailed to you. If you haven't got it, like I said earlier on, if you haven't got it by tomorrow, just pop us an email and we'll get one sent to you manually. Help us out. Obviously, but these are we put these on. These are completely free. Obviously, free to delegates, as you know. Also completely free to lenders as well to present. And we don't do this as a profit centre like many of the financial press do, where they're charging lenders £1,000 just to talk for 20 minutes to people. These are completely free. So help us out. If you can go on either Google or Trustpilot, if you'd like what you've heard today, leave us a review. That'd be much appreciated. If you do go on Trustpilot, don't go to Specialists Hub, which is a training company for something completely different. Otherwise, they'll probably wonder why they're getting loads of feedback saying your presentations were great today, your seminar was great. So please help us out with doing that. Big thank you once again to today's sponsor, which is Glenhawk, and we look forward to having them back next year. Okay, enjoy the rest of I've changed the wording on this for the first time in some time. Enjoy the rest of your day until next month. Stay safe, try to stay sane, and hopefully remain prosperous. Thanks once again, and we're 15 minutes early, so I can get to lunch early. Thanks very much again. Cheers.